Alright everyone, welcome to Foxwoodstocks.com, our webinar on how to sell puts to generate monthly cash flow. I'm Buddy.
And I'm Sam.
And let's jump into it.
Sweet.
So you want to tell people what options are?
Absolutely. So, if you know anything about stocks, you can buy and sell stocks on the market at their given current price, but options allow you to buy or sell stocks at strike prices, different prices than what the market price is. So basically an option is a contract with another party to either buy or sell shares within a certain time frame at a certain price. Okay, so they allow you to trade in calls and puts, which we'll explain in a little bit, and they come in groups of 100 shares at a time. Okay, so it's important to remember. They have an expiration date which can be short or long. It can be anything from a short period, like less than a week, to all the way out several years. So depending on what that time frame is, it's going to change the value of that option. And if you're somebody on the buying side, you are going to pay a premium to somebody, to this seller on this selling side, and you pay that premium regardless of what happens in the outcome of the contract. Sometimes they expire worthless. Sometimes you get to exercise your option and either buy or sell the shares.
Yep, exactly. I think it gets a little bit easier to understand when you start separating between the calls and the puts.
That's right.
You want to tell them about that?
Yeah, so just on the calls side, if you're buying a call, you're basically making a bet that the stock's going to go up. And so you want to call shares to you at a certain price, the strike price, which is above the market value at the time when you make the contract. So if the stock goes up, you can buy those shares at the agreed price regardless of how high the stock goes. Am I correct on that?
Yeah. Well, you technically don't have to buy something above its current price. It's usually you are, because that's where the best value is. Otherwise, you're paying for the intrinsic and extrinsic value at a higher rate. So to just give an example, let's pretend that you had a stock that you liked. Let's call it Workhorse as our example today. And it's currently trading for $21, but you believe that, in the short future it's going to go to $30. Well, you could buy the $25 call, and then once it's above $25, you're making $1 profit per share. And instead of buying 100 shares for $25 each or $21 each, you might only pay $1 each. So you might pay $100 for that call option, but then you're limited to that time window. And the shorter the time window, the less it'll call. So it's the less it'll cost. Sorry. And which basically you're creating leverage, but you're getting a short fixed amount of time when you do so.
Now on the opposite side of that, still on the calls, if you're selling a call, you agree in this contract to sell your shares at the strike price, whatever the contract says it is, and you're collecting a premium in the meantime. So you own shares, somebody buys a call, and you will sell them at that price. Now, on the put side, this is a little more interesting. So if you're buying puts, this is where you're basically kind of getting insurance. You're entering a contract with someone that says they will buy your shares off of you if the price drops to the strike price. So this is where the strike price is below. Now, if you're selling puts, this is where it gets really interesting. You will buy the shares off someone when they drop in price. And that's really interesting if you like the stock. Yep,
exactly. And it's when you're starting out, it is confusing to think about what is a call, what is a put. But you think about it from the buyer's perspective. The call, if you're buying a call, you get to call shares away from somebody else. And if you're buying a put, you get to put your shares to somebody else. And so maybe that helps you understand or remember it a bit easier. And when you're on the selling side, you're just the flip from the buyer. So if you always just remember what the buyer side is, you can figure out what the seller side is off of that. So yeah, at foxwoodstocks.com, the main strategy that I want to focus on and teach is in fact selling puts. But before we get into that, let's talk about some just general myths and things with the market. So just to reiterate and really drive home this point on what is selling a put. When you sell a put, you agree to buy a stock at a future price. Okay, so it's not the price that it is today. It's at any time in the future, whether it's 30 days out, 60 days out, 70 days out, you agree to buy it at a strike price, even if it goes below that price. So you would be the one losing value. Now, the reason we do this, though, is you get premium. You get their monthly premium because the buyer is paying you the premium for selling them, like you said, insurance. Now they can be buying a put because they think this price is going to go down. They could be buying a put because they have so many shares they don't want to lose money if it goes down, which is like the insurance that we talked about. Now, this may sound like, oh, I don't want to lose money if this thing goes down, or I don't want to be on the selling side of this. But think about it like this. If, again, let's use Workhorse as the example. Currently it's trading at $21. Well, you could turn around and sell the $18 put, and if you were happy to buy it at 21, would you be okay with buying it at 18?
Yeah, absolutely.
In addition to that, not only would you be able to buy it at 18 if it falls down, but you still get to collect the premium. You get the premium up front. And that's what makes selling a put so amazing. Because if you're going to put in a limit order of 18, because people do this all the time when they're just trading stocks, like, hey, I want to buy this, I'm going to put in a limit order. If it ever touches 18, then it's going to buy. Well, instead of just putting in that limit order, why don't you get paid while you wait for it to come down in price? So every month, let's say you just month after month, you sell the the 30-day put, so that if it goes below 18, then you buy it. Well, instead of a limit order to just buy, now you're earning premium every month, and that could be hundreds, possibly thousands of dollars a month, depending upon how much you're willing to buy.
Yeah, and obviously if you're willing to buy, you do have to have that cash in your account, or at least the
Buying power? Yep.
the buying power, yes.
Yeah, exactly. And that's exactly right. So the amount that you're willing to risk is the amount that's set aside to buy the put. So we don't teach or do any naked strategies, and which means basically selling a put without having the cash on hand. Now, selling a naked put is actually not that bad because it's the same scenario. The lowest it can possibly go is 0. Now, selling a naked call, on the other hand, there is the risk of it going to infinite or 10x or 100x, which is not very common for stocks to do. But if you were selling a naked call, you would be open to those types of scenarios. But we're going to talk in a minute why you probably can't even do that anyway.
So this is the first myth about trading options, is that you can lose more than you have in your account when using options. And this is a myth because most brokers, these are the people who manage your money in your different accounts, which we will show you soon, they will not let you trade naked options. They don't want to lose money. They have to, in order to be able to even do this in the first place, you have to be at that higher level of trading. So if you're just starting out, you're really not going to have to worry about this, okay? And even if you have that level 3, brokers have these margin requirements, and they're very strict about it because they don't want to lose money, right? Especially, heaven forbid, if you died, then they have to cover all of those losses. So it's a serious problem for them, and they're taking it very seriously. And so the main thing about losing money is just when you're buying options, you can only lose the premium you paid. And when selling options, you only lose stock or cash to cover the trade.
Yep.
So you haven't lost that money yet. It's either going to be cash or it's going to be stocks. And yeah, unless that stock goes all the way to 0 in the next day, you still haven't lost anything. You've got your stock, you've got your cash. They haven't gone anywhere.
Yep, exactly. So that's important. I want to highlight on that because that's really important to understand. Selling a put creates this nice win-win scenario where let's use a 30 days as an example. In 30 days, you're either going to get to collect and keep all that premium, which is a nice APR, nice ROI, or you end up buying a stock that you wanted anyway at a cheaper price. So where is the downside? Well, the downside is if it goes way, way, way below and goes really far down. But in most scenarios, that's not going to be the case. And if you were, let's just compare apples to apples, right? If you would buy 100 shares at $21, you would have lost 21 times 100. If you were to sell the put at 18 and it goes all the way to 0 in both scenarios, then you would lose 18 times 100 instead of 21. So you'd be saving yourself $300 in loss, actually.
Okay. So myth number 2 about trading options is that it's riskier than trading stocks. I think we've all heard those stories from Wall Street bets about somebody losing way too much money, way more money than they had, and we all think about it like it could just happen to anyone, but there's a different reality. So there's a bit of 2 sides to this, yes and no. There is some extra risk when buying, especially long options, but when you're selling or shorting options, then it's not the case.
So buying options, it lets you control more stock for less cash. So it's taking leverage in the market so that you can make thousands of dollars off of smaller amounts of money, right? Instead of having to pay out $100 times 100 shares, you could possibly be paying $10 or $15 per share and controlling, again, that 100 shares. So in this way, it lets you reduce risk because you're putting less money at risk, but there's a trade-off because you're put on this timer. If you buy a 30-day call, you have 30 days for it to move up substantially, and then the trade is gone. Whereas if it took 60 days and you bought a 30-day call, well then guess what? You missed out completely, you've got nothing, and you lose the entire premium. Whereas if you had just bought the stock, you could have held it 30 days, 60 days, a year, 5 years, 10 years. So it's really about figuring out where is that risk-reward strategy that you want. And people, I think when you get started, it seems easier to buy options. But the reality is, you really should be understanding the Greeks and implied volatility and all these other factors that go into it before you buy options. It's actually easier to sell options, and I hope we can explain some of that in today's video. Now, selling options is clearly, just clearly, less risk than trading stocks. And the reason why is it actually decreases your potential dollar cost average. Again, using the example of Workhorse at 21, if I sell the $18 put, I am by definition $3 less risk than buying at 21. I literally am willing to buy at 18 versus 21. Plus, I get to keep the premium. Plus, now time is on my side. Because in order for me to lose any money, it needs to go substantially below 18 within 30 days. Not 3 years, 5 years, 6 years, right? So in all aspects, this is less riskier than just buying and holding the regular stock at today's price.
All right, and this myth pertains especially to me, where you think only Americans can trade US stocks and options. Now, I'm Canadian, I'm also a tax resident in New Zealand, and so this is definitely false. You can set up accounts, especially with interactivebrokers.com, and you can trade with US options. There are a few countries that are not on that list, but depending on where you're from, I would say most people would be on that list.
Yeah, it's just trade relations with the US, and so most countries have an agreement with the US. Myth number 4, day trading is the safest and best form of investing.
I think I know where this is going.
Go ahead.
Yeah, very false. So there's this very easy to remember 90-90-90 rule. 90% of day traders lose 90% of their money in their first 90 days. And there's a lot of reasons for that, but it's mainly because they just don't know what they're doing, and it's a very emotional thing, and you have to learn. It's like a skill. So just like somebody who plays basketball for a living, they had to learn that skill. They can't just hop on the court and start playing with Steph Curry and all that.
Yeah,
right?
exactly.
So it's also not for everyone. If you're somebody who's way more emotionally attached to your money, you worked hard for that, you don't want to lose it, it could be a very rough start. Yeah.
Yep. And worst of all, in my opinion, is it's super time intensive. To be really doing it, you should be studying, you should be working the pre-market, the market, and the post-market. If you don't know what those are, you can check it out. We're not going to go too deep into that. But to me, at that point, you're not an investor. You've basically traded your regular day job for day trading. So you've gone from job 1 to job 2. And yes, that's nice. Maybe you make more money, you get away from the mean evil boss, or whatever the case may be. But you really haven't transitioned into being an investor because you haven't freed up your time.
Yeah, that's a big difference. It's like a job instead of an investment.
Yeah. So today we're going to be using a couple examples to help teach you about selling puts. And these examples come from our reports and from optionsoracle.com, which is a partner newsletter. If you sign up with us in the next 60 days, we will also be giving you a free newsletter subscription to Options Oracle. So be sure to check that out. And I want to go ahead and explain what all of this means and break it down for you so that we translate the gobbledygook to hopefully knowledge while we teach you how to actually sell and analyze selling stock options. Okay? So over here, it tells us that we're going to do a cash covered put. And when it talks about doing a cash covered put, it's talking about selling the cash covered put. Now, how do you cover that? You cover it by having enough money in your account, and then your broker basically locks that money away. It says, okay, if you need $2,100, so $2,100, do you have this in account? Yes, you sell the option, and then it locks away that $2,100, and you cannot move or trade that money until this option expires or until you buy it back. Okay, and then here we have the stock option symbol. That's Workhorse, WKHS, and it's currently trading, this is old news by the way, this is an old example, at 25.78. Okay, and here it says sell to open workhorse December 20th. Again, remember this was a cash covered put, and it says sell to open. Well, that might be confusing if you're new, but we have to sell to open because we're creating and opening a new position. If we were closing an old position, if we had bought, for example, if we had bought the put, we could then sell to close the put. And it's a little bit confusing, but just remember, when you read this, we're selling to open. So if there's an option in that software like there is in Schwab and like some of the other ones I'll show you, then you're clicking sell to open, not sell to close. Your broker wouldn't let you sell to close anyway if you didn't have an open position. But just so you know, we are selling to open a new position. December 20th, because that's when the option will expire, $21. And you notice that at the time that we did this example, when we pulled this example from, it was trading at $25.78. Here it says $21, which is a full $4.78 lower than today's trading price. Well, today's trading price. A little bit confusing, but anyway, this is the strike price. So the strike price can be and should be different than today's trading price. Yeah. Now the $1.50 shows you how much premium you're going to get. Now that's premium per share of stock. So somebody is paying you $1.50 per share of this that they want to have insurance for in case it goes below $21. So remember, contracts are always in 100 shares. So really, instead of $1.50, just imagine the decimal place moving away, and it's $150 in premium. So if you agree to let somebody sell you their shares of stock at $21 in the future, remember at the time this is a $25 stock, they will pay you $150. Now, in Options Oracle, he uses GTC trades. That means good till closed. They don't, you put in the trade, and whether it fills today, tomorrow, or the next day, it stays open until that order gets filled. When we do trades at Foxwood Stocks, we mostly use days. We have a fill order of day only, so it either fills that day or it disappears on its own. And if you do the math, you just take the $1.50 divided by 21, you will see that this is a 7% return in 21 days. Now you might be asking, buddy, how much do I really have at risk with this trade? And to figure that out, you have to look at not today's price. It doesn't matter about the $25.78. What you're going to look at is the strike price minus your premium. So you take 21 minus $1.50, right? You get $19.50, and then you times it by 100 shares because you're doing one contract. So for every contract, you're putting up $1,950 to make $150. That might seem scary, but you'll see that the probability of profit using these trades is very, very high. And again, remember, you're not losing $1,950. You're just agreeing to buy shares at $21, but you get to keep the premium. So your cost basis will be $19.50 per share instead of today's price of $25.78.
Yeah, that's quite a big spread, quite a difference.
It's huge. Now this is an example of our report from Foxwood Stocks. And I want to be clear that we're actually not recommending this trade, and I'll explain afterwards. Okay, so again we show the stock ticker symbol of WKHS, currently trading at 21.13 cents. I don't know why it puts in the 0.5, but it's 21.13 cents. And ours would be expiring on January 8th, 2021, and we would be selling the $18 put and still collecting $1.20 in premium, so $120. And you'll see that this is a 6.67% ROI, return on investment, in 27 days. And if you do the math, if you could repeat this trade over and over again, you would net 86.9% APR. Now the reason we talk about APR isn't because we're going to make the same trade a dozen times, although it is sometimes possible, but mostly so that we compare apples to apples. Is this a 30-day trade? Is this a 45-day trade? Is this a 13-day trade? Which of these two is better? We look at the APR, not just the ROI.
Yeah, because you could have a much higher ROI for a longer term, sorry. Yeah. But at the end of the year, it might be much less.
Yeah. So just to compare different dates between different contracts, we look at the APR. Now, what's great about this trade is you'll see that you have what I call 20.5% drawdown safety. Okay. And what I mean by that is you look at today's trading price of 21.13. And then you take the strike price minus the bid, and you end up with 20% drawdown protection. In other words, what I'm saying is even if this stock price dropped 20% in the next 30 days, you would still collect the entire premium and not own any shares. So you do not lose money trading this stock and trading this put option until after it starts dropping below 20%. Okay? If you bought the stock today at 21.13 and it went down 10%, congratulations, you just lost 10%. If you sold the put and it dropped 10% anytime in the next 30 days, congratulations, you didn't lose a dime, you collect your full premium and actually earn 6.67% ROI. Okay?
Brilliant.
And if you look into most of the trading software today, especially Tastyworks, which is what I use, it'll actually tell you, as you're putting in the trade, what the probability of profit is. So here, it's telling me, based on the trading history of the stock, that if I sold this put, I would have a 72% chance of being profitable.
Sorry, I want to ask, where does that number come from? Because that seems a little crazy to me. 70%. Does that mean that you'll earn 70% profit every time, or 7 out of 10 trades are profitable?
Yeah, exactly what you said in the second method.
Okay.
This means that 7 out of 10 times this trade will be profitable by at least a penny.
Right, and that's just a bunch
in the
of
case, and in
math?
the case, yeah, well, it's this thing called the Black-Scholes method, which is created by 2 MIT professors, I believe doctor, but Professor Black and Professor Shoals teamed up together on this, mathematicians, and figured that out.
Oh, cool.
And again, this isn't saying that, oh, you're going to make 70%, you're going to lose 70%. This is just saying that based off the trading history and the volatility of the stock, that if you make this trade 7 out of 10 times, it'll be in your favor. In our case, that means that we will collect the full 6.67% ROI. Now, notice I have a big red exclamation mark here, not recommended. So we use this stock as an example only because we have the information available for it. But that doesn't mean that we just look, oh, we go in there, we found any stock trading at 6.67% ROI and, oh, it's got a 70% probability, I'm just going to make the go trade and just do it. No. We take our time and we actually do the fundamental analysis for this stock. We use wallmine.com a lot. We analyze its market cap. We look at its earnings. We also see what's going on in the news. We see what's going on with its filings. And here's the big reason why we wouldn't recommend the stock for you right now. At the end of this year, they're going to be competing for a large contract from the United States Postal Service for electric vehicles. They are not the only one competing for that. They were not awarded it early. And there has been 6 months of just general hype and people pumping up the stock and being super excited, thinking that that contract is like a for sure thing or that they're in the lead. But there's multiple companies competing for this. And what that means to me is that it's not worth taking the risk to make 6% dealing with a stock that I believe, in my honest opinion, is either going to double in price or halve in price. I don't want to try and make 6% for something that can go down 50%. And if it's going to double, I don't want to miss out on the doubling. So to me, I'm not recommending this sell put because of these scenarios. Now, the reason that I'm telling you all this is because you might see this video and go, oh, it's so easy. I just go find 6% ROI. I go find, this high probability. But here at foxwoodstocks.com, and the reason you'd want to subscribe to us is we actually take the time to do the due diligence, and we're only recommending trades that we do in our account.
Yeah, and that's really important, but also it's like you can look at these numbers all day long, but guess what? If you don't see that news or if you don't understand what the company is doing, what the CEO is doing, and all of these sorts of really fundamental pieces, then you will miss out on that crucial information, which could totally change the game in terms of the trade you want to make.
Absolutely. And if you haven't tried it before, I'm not paid or sponsored by wallmine.com, but I use this resource regularly. It shows you the news, it shows you their filings, and it shows you insider trading. It'll also show you income statements and balance sheets, so you can spend all day doing your research on one website. And if you don't want to do the research yourself, you can subscribe to foxwoodstocks.com and leverage our time because we do the research for our own trades and then we share them with our members.
Right on. Should we get into some examples of how to trade?
Sure. So first we're going to be showing you on Tastyworks. This is an example of what it looks like. But this example was pulled previously, and so today's example is going to be a little bit different because I'm going to show you what it looks like with live prices.
Okay, so I'm seeing a lot of numbers, a lot of different things. Obviously, if you want to learn how to use the software, that's going to take a little bit of time, and we do actually have a video showing you on each different software how to enter trades. So we're not going to go into all that detail, but in terms of selling a put, we're going to show you how to do that right now.
Exactly. So you come up here to your top left, you're going to type in Workhorse, WKHS, right? Click on it, and then it's going to show you all the different expiration dates, okay? And we chose January 8th as our example, and the $18 put. Now previously, if you remember from our previous slide, when we had this in our report, again not recommended but as considering, it was the $18 put at a $1.20 bid, okay? Now if you made the same trade today, it would be $18 put again, but you'd actually be making $40 less. And that's the difference between, that's the difference a few days makes in options trading. Even though the price is still up here at 21.42, in our example the price is 21.13, because the implied volatility has changed, the price has changed by over 30%. Which is why another reason you want to subscribe to foxwoodstocks.com, because even if you were to go out and find the same trade, being a few hours or a day late changes it completely. Okay? But just to go through the platform, what you'd want to do is click on, see up here you'll see that these are the puts on the right, sorry, right there. Okay, see puts, and then you'll see bid, ask, mid, and touch. Now your columns might be in a slightly different order, but you should see the bid and the ask. And you come down here to 18 and you click on bid, and it automatically assumes that you want to sell. That's why it does S1, you're selling one contract. And if you come down here, you'll see that the probability of profit has actually moved up because of the shrinkage of implied volatility. So you're earning less premium, which is the $80 that you would collect. Again, that's 80 cents times 100. But now you're getting a 75% probability of profit. Now personally, I'd rather take the 72 and $1.20. It also creates more drawdown safety because you're getting farther away from the strike price with all that premium that you collect. But using the Black-Scholes method or newer methods, you're getting a probability of profit of 75%. Now we're going to skip most of these, they'll be in our advanced courses. And over here it shows you this is your max profit of $80 and it shows you your max loss of $17.20, which is an easy way also to figure out your total, what will be your cost basis or your drawdown safety, because it's not the $18 strike, it's the 18 minus the 80 cents. So it's actually, if you add a couple decimals to this, it's $17.20. So what you're saying, just to clarify that again and again and again so that it sticks with you, even though you're selling the $18 strike, your total cost basis, if you were ever to get put the shares and have to buy them, your real cost basis will be $17.20, not $18, and not today's trading price of $21.42. And that's what makes it so much safer than just buying and holding stocks.
How do we put this trade in now?
Yep. So I'm just going to double verify everything. Down here it shows the quantity, it says January 8th, it says the number of days available, 23 days available, 23 days left to expiration. You can play with the slider here to change the price, but if you go in at the bid, you have the highest chance of that order getting filled, so most of the time that's what I do. Over here you might see order limit, make sure that's set to, order type, make sure that is set to limit. Over here you'll see TIF, that means time in force. And we want to make sure that is day, because I don't want, if this trade doesn't go through and the price drops $2 tomorrow, I don't want it to fill tomorrow. I want it to fill today while the price is still $21. Okay? And then I'm going to hit review and send. It's going to say, hey, it's going to let you choose which account you want to put it in. It's going to show you how much buying power you have. It's going to just clarify or confirm the trade before you put it in. And then you click send. And in our case, I put in my orders before the market even opens so that it's not actually about to go through, it's just waiting, it's pending. And if I wanted to cancel it, I just come over here to activity, I'll see the trade is here, I can right click and cancel the order. Easy peasy.
Nice. That's pretty good to know right away before you hit any buttons or put any money in, knowing how to cancel it just in case.
Yep, exactly. Alright, I'm going to show you the exact same thing in two more platforms. We're going to use Thinkorswim and Charles Schwab, which is Street Smart Edge. Here we have Thinkorswim. If yours looks a little bit different, come off of monitor, make sure you hit trade at the top up here. I've already typed it in, but again, Workhorse WKHS. It'll show you today's trading price, 21.27. It'll have a bunch of dates. Come here, click 8th of January, not January 8th. They do it a little bit differently. It's 8th of January. You see here the $18 put, and you'll see it's the same price on Tastyworks because that's the market price. It's not set by the broker. So you click on the bid column. Again, puts are on the right, just like before, bid, and then it's going to open this up. And it says spread single. That means that we're actually not opening up a spread. There's different types of options we can teach you guys later, but we mostly focus on these single put order cash covered puts. So that's fine. We're selling it. We're not buying it. And when you sell on Thinkorswim, it uses negatives. Okay, so we're actually negative one contract because we're selling the contract, not buying it. Here's our symbol, here's our expiration, here's our strike price, 18, tells us it's a put, yes. We don't change the link. Here's the price, we want it to be a limit order, so we leave this at limit. We want time in effect or time in force to be day. And again, everything is pretty much the same as Tastyworks, but it's all laid out a little bit differently. And so if you're not familiar, it can be confusing. And again, here's our confirmation window. And I'll have the money in the account, so I'm not going to hit send on this one. But that's how you put in the order. Yeah. Here we have Street Smart Edge from Charles Schwab. Again, you would come over here and type in Workhorse. Now you see some tabs here. So make sure you're not on stocks and ETFs. Make sure you're on the options tab. We're going to be looking only at puts. Here, it defaulted to the closest, which is December 18th. So I'm going to close that and come down to January 8th. We're going to scroll down and find the $18 put. We're going to click on bid. This will not automatically assume that you want to sell. So you do have to come up here and click sell to open. Here's your quantity, here's your limit. Just making sure it's going through okay. Yep, okay. And then here it is, sell to open, Workhorse, January 8th, 21, $18 premium. It would have the other information in here. I don't know what the errors and warnings are today, maybe it's not updated, but that's basically how you would put in the trade, and then you would hit place order. If the order did go through and was working, you would see it over here on your account details, and it would be as simple as right-clicking and click cancel order. And that's it. So I want to thank you guys for watching the video here today. We have a fantastic offer for you guys. We have a completely free program. If you want to go to our website, foxwoodstocks.com, and sign up for the free membership, just go to foxwoodstocks.com. And the free plan, you will get basic investment video courses, you will get our educational articles, and we even give you one free trade alert per month so that you can start trading and earn the money that you need to actually pay for our subscription if you're not in that, income ratio bracket right now. So if you need to build up your account and you're ready to get started, but you want to take it slow, just sign up for your free account. If you have a larger account where you're ready to get started and get serious in your trading, then look at our other premium courses. Just go to foxwoodstocks.com/membership-signup and consider one of our other courses, such as the Beginner Investor at $99 a month or the Advanced Investor for $249 a month. We give you the same video courses, but we also give you more video courses. We give you unlimited trade alerts on Sundays for the beginner. We give you unlimited trade alerts every day for the Advanced Investor. We have money back guarantees. We have advanced courses for you guys. And we have, for the beginner investors, we give you guys the safest trades possible that will still making significant returns. But for you advanced traders, we even open up the door to our higher risk, higher reward market scans and trade alerts.
Yeah, so there's really no downside, guys, especially if you just want to hop on that free one, if you're just getting your feet wet in trading. But to be honest, if you're the sort of person who you've already got some money on the market and you're really wanting to maximize that potential, then you should definitely hop in one of those paid plans, because ultimately that's going to give you the best value for money and you're going to get way more returns, whereas in the free plan you can only get a little bit out of it.
Yep, that's absolutely right. Well, that's it.
All right, yeah, thank you so much, guys. I'm really glad to be joining Buddy here in Bali. It's such a beautiful sunny day, so I think we're going to go to the beach now.
Yeah, sounds good. Thank you guys. Have a wonderful day. Happy trading. If you have any questions, just go ahead and comment in the section below, and don't forget to subscribe.
Yeah, awesome. Catch you guys next time.